if you are out there and you're buying in your first home, I'm going to look at a way in a cross comparison of why you might want to think about, or at least get educated on, what an adjustable rate mortgage is. And I'm going to dive into a real life example to show you on a VA loan at $600,000, what that would mean for you, not only the first 60 months, but after 72 and into month 84, just so you can get educated, should you even consider an adjustable rate mortgage? We're going to get into the financial mechanics behind it, because to me, this is important to understand before just flying off the handle to say, well, no, ARMs are a bad loan. Well, maybe, maybe not. So this isn't to convince you, this is to educate you. With Mortgage Meister Group here in Denver, if you like educational videos as you're looking to get into the home buying journey, for my veterans out there, thank you for your service. Fellow vet here. FHA buyers, this can apply to anybody really. It's just more of an education on what adjustable rate mortgages are and how they may help you, may not help you. First of all, we're going to talk specifically about a VA ARM in this example, but for my folks out there with FHA, this applies to you as well. Education first. 5-year ARM means that the rate and payment are fixed for those first 5 years, and then after that it would adjust annually. How does it adjust? Well, it's built off of a fixed margin and then the index, which is the 1-year CMT, which you can look up online to understand the history of it. And I think this is an important thing. So if you look back in time, say 5, 6, 7 years, what was going on with that at that time? Because that would be someone who's coming up for adjustment now. And history could maybe help you understand so that you feel more comfortable to know, well, what might happen? Well, after the 60th month, the adjustment can be up to 1%, but it goes by 1/8 of 1% increments. So technically your loan may not adjust. It could adjust 1/8, could adjust 1/4, 3/8, etc., up to 1 full percent maximum. And then yes, 12 months later, again, where what's going on with the 1-year CMT at the time of adjustment. One thing I'm going to teach you about today is how much you might be saving over the period of that 5 years. And some things to think about what you might do with that money, again, so you can decide if an ARM is right for you. Okay, so first and foremost, let's set the stage. $600,000 mortgage, the going rate on a fixed at 6.375%. This is all just purely for educational purposes, okay? Now you're gonna see a lot of information on the screen here, but stay with me so that I can walk you through what I'm talking about. So what you would actually see is that principal and interest, $38.23. Now this assumes a funding fee. And I get too technical on you guys here, but I want you to see the math. That's the 30-year fixed, 6.375. This assumes paying 1% discount fee to get that rate. Blah. Now, in that same example, if the person did the 5-year ARM, they would get 5.625. This is where things get interesting because you're actually going to see that the payment savings is substantial. You can see there's almost $300 per month. Okay, so after 60 months, that person with the ARM, we can all agree, would owe less money because they have a lower interest rate. Okay, now this is where it gets interesting because you have about $300 a month extra if you took the ARM. What do you do with it? Now, I'm not going to get into what you could do with it if you put it into the S&P historical returns over 5 years. What does that money become? I'm going to say, well, what if that person took the same approach with their budget because they were going to do a fixed at 6.375 and instead they took the ARM, but for 60 months they took that $295 and they plugged it back as additional principal. That balance on the ARM is $23,000 less after 60 months. Therefore, remember back to the beginning about the adjustment. If it adjusts the full 1%, you have a 6.625. That payment is lower. Why? Because the balance is less. So technically, for that 6th year, you're paying less as well. So if you took that savings, which now is roughly $70, then after 72 months, you're $23,000 ahead in balance on the adjustable, even though it has a higher rate. Now, just to be fair, I did say, well, what if it becomes 7.625 on that adjustable going into the 8th year? Now you can see that's where the payment becomes close to $300 a month higher on the adjustable versus the fixed. So thinking about, should you do the ARM? Should you do the fixed? If you're very disciplined with your finances, if you would take that money and invest it, that almost $300 a month for 60 months, you would grow it depending on the rate of return. If you took it and applied it towards the balance, that is a guarantee that you will be $23,000 lighter in the payoff And if you think you're going to refinance, then the adjustable rate mortgage for that VA loan and or that FHA loan, boy, that sure looks good. This here is a way that you could end up owing less at the time. And if you think you're going to refinance the next 5 to 7 years, ironically, as you can see here, it's really the 7th year when things get interesting. But for that 6th year, you're still better off if you took the disciplined approach and applied the money. All that to be said, this is purely to educate you on the process. We have more educational videos. If you are interested in adjustable rate mortgages or want to get more knowledge on it, just drop a comment arm in the section below. If you have questions or experiences with adjustables or concerns about adjustables, drop those as well. And if you want to have a consultation, calendly.com/mortgage maestro. I really hope this educated you along your home buying journey. Thank you so much.